Thank you. Not too long ago, AI seems a distant dream for all of us, or something that only happens in science fictions. But now, suddenly we found out we are actually living in the midst of surge of interest and research in AI. It seems like every week there is a new breakthrough in a field and a new record is set. AI is becoming today's most important enabling technology. On the stage, we have a group of distinguished investors who have extensive experience in AI. Let me introduce each of them. David Wild is a stock market expert, best known for his position as the vice chairman of NASDAQ. He is currently the founder, chairman, and CEO of Wild & Company, Inc., parent company of the investment banking firm Wild & Company. Eric Yang is the founding partner of Glory Ventures. He has extensive experience in early stage investment in IoT and artificial intelligence in China and Israel. Chen Shi is the vice president of TFTR Investment and the director of the High-End Manufacturing and Healthcare Management Committee. He holds a master's degree from Peking University. And Gao Tianyao is the partner of Legend Star. He joined Legend Star in 2016, and he specialized in emerging technology investment, including but not limited to AI, robotics, and smart manufacturing. So I will start my question for each of you. When you evaluate the rise of AI, how would you break it down by geography? What's the common theme across regions, and what's different? We start from David, and each of you, I would like you to answer this question. David, please.
Well, geographically, I think most of the AI work in the United States is concentrating in places that have, concentrations of computer scientists as a starting point.
Yes.
So we're seeing quite a bit of it out in Silicon Valley, and in particular, San Diego. We raise institutional fund money for venture capital investors in AI, and there's been a pretty fair concentration of computer scientists coming out of the Defense Department and other places that have been aggregated there. But the application itself, I think, is really less geographically constrained to places where the data is aggregated, and that can be in financial services, that can be in New York, in agriculture, as you just saw, that can be distributed. When it comes to climate, that it can be distributed as well. So that's how I'd answer that question from the standpoint of the United States. Yeah.
Thank you, David. I will follow up with this question. What do you think the difference between United States, Europe, and China?
Well, I think the government in China, I mean, this is my perspective, is very much behind AI, but it's focused in certain areas that maybe the United States is not focused on. A lot of it is sort of much more free markets and less government driven in the U.S. And so we're seeing, for instance, a lot of application in healthcare, in particular, like genomics, and increasingly reading things like mammograms to human beings that have to read medical images actually tire and they miss things, whereas the thesis is that artificial intelligence is not going to tire and will do a significantly better job at identifying precancerous and cancerous images.
Thank you. Eric, we know you are doing investment in both China and Israel, and maybe other regions. So how would you view the difference and commonality?
Yeah, so based on our investment philosophy, usually we break the AI industry to two layers. We say it like in the bottom layer is kind of the infrastructure technology or underneath technology. And in the upper layer is more like application oriented. And we think geographically to see, I think like US is developing kind of very well balanced. So a lot of innovation are happening in underneath technologies, infrastructure layer, like AI chips, new computing storage infrastructure to enable the AI. And also in the upper layer application, US is also like developing very fast. But if we take a look at China or in Israel, it's kind of very interesting. In Israel, we only see many innovations in the breakthrough technologies in the infrastructure layer, like a lot of companies developing chips, new storage stuff for the AI. And China actually is developing very fast in the application layer because of the population, because of the data generated. So that's why, like, I give two examples. Like in Israel, the most representative company will be the Mobileye, a company developing a chip for ADAS and autonomous driving. The company spent 20 years for exit and $15 billion US dollar acquisition by Intel. And in China, actually, we see like in companies like Face++, SenseTime, they are developing the algorithm, the software, and it's kind of universal platform for many different sectors, and they are growing so fast. It's kind of already leading the market in the world. And it's kind of application oriented, and because of the benefits of the China market. So that's how I see the difference between China and Israel.
Thank you.
Thank you for having me here. First of all, let me introduce my fund a little bit because it's related to the question. Legend Star Capital is founded by Legend Holdings. We are a financial investor focused on early stage investment. From past, we start our investment from 2010, and overall we already have over 300 portfolio companies, and among these, over 90 are AI companies. So we invest AI for being a long time ago. Actually, we invested our first AI company called Zhongke Hongba, which is iris recognition company. By the time 2010, it's really been well. So among our AI portfolios, 40% is in the US. So that's yes. So we actually let me read an example. Actually, we kind of invest the same kind of technology both in China and the US, and we see the difference. We see the results. So the result is the company in China is actually is better development than the company in US. But this is just one case. But what I want to say is, like the first speaker said, the China government and the environment and the whole system, especially supply chain in Shenzhen, is make in my opinion, much difference between us from the other countries. So I think we are, and the US are in the leading positions.
Thank you, Go. 40% of portfolio in the United States is quite amazing. Chen Shi, so how about you? How about your firms?
Okay, let me introduce my firm. Actually, we are a private equity firm under Tianfeng Security, a public company, just publishes March this year. Actually, we are very conservative fund. In the record, we haven't actually invested in any AI companies, honestly, because I think the AI technology is like other technology. It's just a technology. Right now, you have to be afraid of it, or you have to worship it. You don't have to put a mystery to it. It's actually this level of AI. Actually, it's a second generation of AI. Is deep learning. Is based on deep learning. Deep learning is actually based on the data and the algorithm. Actually, from geographically perspective, China, based on its population, has a lot of data. consumer data, traveling data, production data, and American has a best algorithm, I believe, because I actually graduate from American school. From that perspective, I think it's better for actually both countries to cooperate, actually to work on this new generation of AI to actually benefits different field or different industries to benefit from this actually, I'm sorry. How to say it, to benefit from this AI booming, actually.
Oh, thank you. Yeah, AI is not much different from other technologies unless it's empowering different industries. So my next question will be, among healthcare, transportation, finance, etc., in which sector do you achieve or expect the highest return with AI-related projects? We start from Gao. We start from you, yes.
Okay. In our opinion, I think all these sector, I think, let's say the AI have the opportunity to empower all the sectors, like right now the securities, transportation, even finance, healthcare. A lot of AI startup companies root their business and fund their business model and develop a very good product. So the question is when the timing is actually the key. So by the different order, maybe some some sector is have a lot of data already have, so it's easy for the AI to empower. So we think the matter is the timing.
So you think data is very important in a sector who already have a lot of data, it's easier to do the applications. But people are actually questioning that because finance, healthcare, they have a lot of data, but it's not available for the technology companies. How do you think of that?
It's a need a time for the tradition or the industrial knowledge to better export their to imply their technology in the field. So it's a kind of need to take a time, especially finance and healthcare.
Okay, thank you. David, the question is for you. Previously, you were the vice chairman for NASDAQ. I don't know whether you have the statistics on NASDAQ, how many listed companies they have relates to AI technology and which sectors they are actually more active or popular for AI companies.
Well, I completely agree with his point of view, which is a lot of it is of where you're going to apply it as a function of where the data sets naturally exist. So you have a whole suite of companies now that are looking at trying to create their own proprietary data sets. The agricultural example right before this is one with the drones. But for example, I'm working with a group of entrepreneurs who were the first to do the video. They're terrific sort of Russian Uzbeki computer scientists who did original video on demand technology in the United States, sold the business, and now they're looking at going into some of these developing economies like Uzbekistan, and the quid pro quo is we're going to turn all of your healthcare records electronic, right? And we're going to turn you into an area that does clinical research trials, drives down the cost for pharmaceutical development, and the quid pro quo is that you will get lower cost pharmaceuticals for a developing nation. But what happens there is that they're going to convert that whole economy into a massive data pool. And that will facilitate all sorts of discoveries on drug-drug interactions and the like that you can, because you'll be able to mine using algorithms that, what the patient outcomes are as a function of what sorts of things they've taken. So I think it's, if I go through the book of NASDAQ companies, I think there are lots of already public companies that are beginning to dabble with artificial intelligence applications, and a lot of the big Wall Street firms have been at it for a while. A lot of the big asset managers like D.E. Shaw, which is a very well-known hedge fund in the United States that's been has been employing computer scientists and mathematicians since the day it got into business. I think it's actually a little bit more, in some respects, commonplace than people generally give it credit for with certain leading-edge, large financial institutions, for example.
Thank you, David. Eric, what's your opinion?
First, I think my opinion would be biased because if I take a look at my portfolio, I think I have 9 or 10 portfolios in autonomous driving and ADAS. I have like 3 to 4 fintech companies, and I have 0 in medical because I have very little knowledge on medical. So, and also another reason is that I believe like especially like in China, we don't have a sufficient data set from the medical because we still have problem in the electronic medical record sharing. A lot of things are kind of preventing us to have enough data. And I'm more bullish on transportation because simply just imagine like how much time you spend on each sectors. Like every day you spend some time on transportation, right? And you spend less time on finance, investments, or medical. So that's my very simple answer to this question. I think transportation will be something like which will give you have like a very great impact because of the AI. And the second thing is that we were asking like what will be the highest return generated from investing in a startup in sectors. I truly believe that because transportation or autonomous driving, it's a very long supply chain. Because if we take a look at the autonomous driving car we have now, we need to have a lot of eyes sitting on the cars. So it's kind of camera, radar, LiDAR. It's different sensors give you a different angle of the perception capability. So we need a lot of sensors, and we need a lot of processors. New processors to handle this huge amount of data in real time in very little latency. So there's a lot of hardware infrastructure we need to have for the car. And then we have needed to have a brain on the car, like a human brain. It's kind of a very complete AI and software and algorithm. And then we also have to have like a smart brake and other system to enable the autonomous driving. So it's a very long value chain and a lot of opportunities for investment. So that's why we see like huge investment is putting into this industry, and we see a lot of players are getting into that, either like OEMs, ride-sharing companies, big tech companies like Google. So that's why I have made a lot of investments in this specific area, and also because of the regulation like in China and Israel. China is not easily letting like US companies get here to get the HD map to do smart driving. So a lot of chance are leaving to the Chinese companies. So my answer would be transportation, yeah.
Thank you. Yes, mobility is really a big sector, and all the automobile companies, they are actually transforming from manufacturing to mobility companies. Our next question is, what kind of ecosystem will boost AI development and adoption? And the follow-up question is, what is AI's Achilles heel? So I'd like to have Chen Shi to answer this question first, and follow up by Gong.
Okay. I think the question is based on how the AI works and what's the best environment for the AI to run. I think since deep learning is based on data and algorithms, so the clean data, standardized data is more important. So to get clean data, you have to reduce human intervention. So for AI to solve things, you have to pick certain scenarios with less people intervention. And for right now, I think AI is best for solving engineering problems. And if you're trying to use AI to solve social problems, I think it's not a very good timing to do that. And to have a so I think why the Alibaba Facebook is so big because they have a lot of clean data, and those data help them to polish the algorithm and develop a better AI. That's what I think. Yeah.
Okay, we mentioned data a lot, but besides that, we think there's also policy, ethics, talents, and various groups, organizations. So, Gao, what do you think about the ecosystem?
Yeah. My view very simple. From as a early stage or angel investor, I think the most important thing is you need to have the long time patient capital to finding the startups. As an example, I mentioned we start our AI investment since 2010. We are the angel investor of MacV, known as Face++. The time is 9 years ago, so it's really need a time to, endure the technology, transform into the product. As a last speaker, GFei company, right? I think it's you got founded company 5 years ago, right? I heard GFei a long time ago. So it's finally you see the results. So your second question, my answer is not the data. Data I already answered in our group chat. So the patient is very important.
Eric?
Yeah, I think my argument will be very similar to Ms. Gao's points. I think in order to have a better ecosystem for AI, we need to have those long-time investors and partners or customers, which we can be more tolerating, like this slow progress in terms of monetization, commercialization for these AI companies. I think Face++ is a perfect example. We observe another company, like I mentioned earlier in the talk, there's an Israeli company called Mobileye. They founded this company in 1999, starting to working on autonomous driving. So nobody believes that in 1999, when we can have a chip to process all the vision, all the pictures we're taking, and then to help the car to drive more safely or even become an autonomous vehicle. So the company took 8 years for getting its first design win in 2008. And then it takes another 7 years for the company to go IPO in NASDAQ, I think in 2014. So it's 15 years after its foundation that the company went to IPO. And then 3 years after the IPO, the company was bought by Intel for $15 billion, which is kind of the highest record in the acquisition in AI. So that's also I think in Israel, in the US, investors are very long-term oriented. So we're not short-sighted. We're not judging our companies in terms of the commercialization, monetization, which give a lot of room for the startups to grow, to increase their technology barrier, to have more data, and to refine their algorithm. So I think in China, in the last a decade, although we are developing very fast in business model-driven innovation, in some application-oriented stuff, but we are still lacking of many underneath technology breakthroughs. So investors should be more long-term oriented to give them more time. And I think in the next 2 decades, 3 decades, we will see more Chinese companies are working on these very disruptive technologies.
You raised a very interesting question. Investors need to be patient. But that seems a fundamental conflict because the venture capital, they have 5+2 years, 7 years term, unless you are evergreen fund. So how would you solve that?
Look, you raise a good point. I mean, first, I think governments and government money, that's a place of really patient capital and long-term objectives. I think the Chinese are doing a better job of it than the US frankly, in that area. But I don't think, you know, investors many times are patient. We're trying to make them be something they really aren't. And, you know, there are different, you know, sort of investments that you can make that are really more marginal as opposed to quantum leap improvements where the data sets already exist. And if you can make a marginal improvement in an algorithmic investment model, you can actually make quite a bit of money, and the horizon is not that far into the future. So investment selection matched to the types of investors you have, I think, needs to contemplate that. There's a whole host of things that you can theoretically do, but the data procurement and the data delivery is very complicated, and genomics is one of them, for example. And you look at the complexity of, we're starting to understand complexity of, in proteomics, you know, one protein, one enzyme may have 20 different 3D formations, each of which have different kinds of activity, and we're just on the cusp of starting to understand the actual complexity and how to aggregate data. So, you know, you're going to be in the early throes with some products of a level of data that is only going to grow orders of magnitude over time, and the data scientists figuring out how to structure these things, but over the near term to be able to monetize and get some value out of it, to live, to ultimately drive that technology to its logical conclusion. It's going to take an awful lot of discipline on the part of scientists and engineers. So, you know, there are short-term things you can do. There are longer-term things, but you've got to be very careful, because that capital may not be there to take you to the long term if you're sacrificing profitability.
It's a very valid point. My school, I graduated from MIT, I think 2 or 3 years ago. They set up a specific organization to solve the problem, because for biotech, for energy, you have to be patient. No VC cannot do that job, so they set something for that. I think that's why the ecosystem is important. It's not only VC in the ecosystem, but also government, long-term capital, and endowment funds, all the other players.
Well, that's your science and technology board here, right, with the Shanghai Stock Exchange, that in theory, you should be able to get some of these companies that are not yet profitable into the public market sooner, so that you lower the bar, and so you address that issue of lack of patience on the part of venture stage investors.
Yes. The next question is, what is the biggest challenge when you're valuing an AI company? That's actually a quite good question. So I'd like each of you to give a concrete example. You don't have to mention the company's name, but can you just give some example with more details? How would you evaluate an AI company? Who would like to speak first? Eric?
Okay, yeah. I can take it. I think the biggest challenge for evaluating an AI companies is also related to our last question, because it took much longer time for they to reach the milestone, to win their first customer, and even to get break even. So like the amount of investment required is usually much higher than other companies. So like as an investor, usually we do different types of valuation settings. So usually we will calculate like how much money you need for the next 12 months to 18 months to reach your next milestone. And for AI companies, either it's chip or algorithm or some other application, it usually takes longer time. And in 12 months, in 18 months, they have to burn a lot of money, because they need the best talents to get them from Alibaba, from Toutiao, and they pay a lot of salary and ESOP to these guys, and the burn rate is very high. So in 12 months and 18 months, maybe they need like $10 million US, $50 million US. And in China, I think the investors are kind of very generous. I think like in the US, usually like an early stage investor, they can take even 50% of the company or 30% of the company, because they bear a lot of risk. In China, usually we are very nice, friendly investors. We take no more than 25%. So if they want to have 10 or 15 million US dollar for the next 12 months, 18 months, we give them a valuation like 50, 60 million US dollar. And we think we overpaid because it's too much. It's too much money for early stage companies. But because they are developing AI, they have the best talents. And we need to guarantee that, okay, they have enough money. If they only give them 5 million, maybe they burn the money within 6 months, and they need to raise another round with no milestone reached. So that's something like, I think it's very, kind of very complicated in the market, and sometimes we want to fight for the best company's best team, and then we overpay.
Okay. Gao, you like to give some comments? Gao?
Yeah, it's a easy question, but it's also very difficult to answer because last 3 years or 4 years, the valuation in AI area is higher than other area in China.
Do you think there is bubble?
Yes, but I don't think bubble is all the bad. So I think bubble raised the opportunities. So the valuation, I agree with the Eric. The valuation from the early stage investments, we see milestone is very critical. So what amount of money do you need to achieve the next milestone? So it's a kind of negotiation, right? So it's basically on the supply and demand relations. More VC wants to invest AI. So if you are the top in your field, you must be expensive. So that's my comments.
So they are too expensive. That's the challenge. But how would you evaluate an AI company? What will be the key factors you look into?
There's I think there is no universal standard for the evaluation, even not AI companies. It's a case by case. So that's the way.
So that's a secret.
Yeah.
Okay, Chen Shi, would you like to comment on that?
Sure. Actually, it's a very hard question because when you evaluate on AI, you based on the technology, the scale, the people, you cannot quantize on those data, So you have to actually to see it as just a regular technology company can solve the real problem, can boom the efficiency, lower the cost. If they can do that, I think it's company worth investing. But the problem is most AI companies at its beginning stage and haven't been earning yet. So you have no easy way to determine the real volume of that company. Not like a profitable company, you can just times PE, so you get a number. It's not like that. You have to actually to see the market size and see the competitors and see how the need actually the market needs for that kind of technology is a real need or is a fake need. You have to determine that. So as I mentioned again, and the AI company is based on data. So it's small company, you have no data, you have to buy data, or you have to actually surround it to a BAT company. So that's why it's so hard to invest in AI companies. Because if something shining or something has its uniqueness, it's already been purchased by those IT giants. So for us, I think it's based on knowledge, and the second is based on luck. Thank you.
Okay. We heard a rumor that in some stage, investment first just count how many PhDs in AI are in a firm. Have you done that? Is that true?
Definitely not.
Okay. David, do you like to comment on that? How would you evaluate the AI company in the States and in your firm?
Well, I mean, you know, the public markets have a long history of when they don't understand valuations, they try and rationalize their way into the valuation. So if you go back, I mean, it's funny you mentioned that. I mean, in the early days of the biotechnology market, public companies were evaluated as multiples of PhDs. And then you went into the internet and they were valued by analysts on Wall Street as multiples of eyeballs, right? Then, right? They had no way, nobody knew how to monetize them. And it wouldn't surprise me that we go into an irrational exuberance phase in this sector as well. But on the venture side, you know, the first consideration is, you know, the first money is not going to be the last money. And so you're going to have to bring in other investors along with you to scale a company. And so the initial valuation also can't scare away the talent. The talent, you know, has to feel, because they're the ones that are ultimately going to drive your valuation. So sometimes these earlier stage investments are done more qualitatively than they are quantitatively. I mean, we're hoping that we have a very large market. We have a very talented team. The fund in the West Coast that we work with that has the largest AI laboratory on the West Coast, I mean, they start companies and they use these pools of founder shares that are awarded to the data scientists as a mechanism to hold on to that talent, because they're afraid that the market is going to get so hot that the talent will be bid away. And so they need to make it painful for them to leave. So I think how we value these companies is a little bit different right now, because there are market forces in play that are causing people to, I think, inflate values compared to certain other industries.
Thank you, David. The last question. What's the most important factor that bonds an AI team together? I'd like each of you to answer that question in one sentence. We start from Chen and ends with David.
Me?
Yes.
One sentence? Big fat check. Thank you.
That's 3 words. Good. Okay, Gao.
Clear goals.
Clear goals. Okay.
I think for me, strong determination. Strong determination for for the vision of the company. So maybe I just have 2 more words, 2 more sentences to elaborate. Like for AI, take level 4 autonomous driving for urban area, complicated urban area. So if you ask me the future, like in which year we can reach level 4 autonomous driving in complicated urban area, like in Shanghai or Beijing, actually I don't know. If you ask experts here, people from OEM, and people doesn't know. So if you're
Elon Musk just next year, he's going to apply that.
Yeah, he's very aggressive. Yeah, but to be honest, any startups, teams working on this type of level 4 autonomous driving, they don't know like in which year they can reach this target. So they must have very strong determination, knows, okay, I want to fight for this goal, and I can spend like another 10 years on this market. It's not like doing some other easy stuff, which in 3 years, 5 years, you see a goal. But if you're working on this type of task, it can easily take you 10 years to reach that goal. So if you don't have a strong determination, I really doubt the team, maybe like they can get split like within 3 or 5 years.
Okay, thank you, David. That's more than one sentence, but we like your elaborations. David, please.
A shared passion and commitment to the vision. You know, we want to make money as entrepreneurs, but but entrepreneurs that are successful are really achievement oriented. I mean, they're a different breed, and their eye is on the prize, the goal, and the goal is creating something that didn't exist before that makes a contribution on some level. And so it's really critical that everybody's on the same page and shares that vision, the passion for the vision.
Thank you. It's a wonderful discussion. Thank you all.
Thank you.